I'm Scarlet. This is Bloomberg ETF IQ, where we focus on the access, risks, and rewards offered by exchange-traded funds. Zero-sum game will venture to the dark side of buying funds that cost next to nothing. Debbie Furr of ETF GI will be our guide. Romo or FOMO? Like the former football star, we examine the strengths and weaknesses of the trend-following ETF and the costs of missing out on this play. And sea change. Shippers race the clock to meet new international rules on changing the sulfur content in fuels. Which ETF is most exposed? Now, whether you embrace or reject ETFs, there's no getting around their influence. And Eric Balchunas is our very own ETF specialist, and he reads the flows to extract bigger themes in the overall market. So show us what you found.
Thank you, Scarlet. Yeah, so we talked last week about, and all year, about a skittish bullishness. Nobody going all in. Looks like it's going to a more unbridled bullishness, at least in the last week. And I'll tell you why. I've got 3 charts to show you. SPY, the Qs, IWM, right? This is that trader crowd risk-on type flows that, again, we've seen this a lot, but it's a little different this time. One is you've got more international and emerging markets action. So let's look at that. International and emerging markets have been the missing link all year. And you're not going into EM unless you're feeling somewhat confident. So you can see the flows here had up to zero for the year, but lately they've been trickling in. Again, a trickle here is a good sign here, and it's also trader ETFs like EM, but also the allocators. So both sides jumping into the international trade right now. And the other chart is just that risk-off and safe haven ETFs are stopping to see inflows because all year those SPY IWM inflows have been coupled with hedging inflows to these more risk-off type ETFs, things like low vol, gold, and fixed income. That is going down. And in fact, it's down here. And in fact, low vol is seeing its first month of outflows all year, right? That's a big, significant sign, Scarlet, that, you know, this might be a little different this time. I've been talking about this sort of like schizophrenic nature here. Could be a regime change. We'll see. It's only a week.
So picking up risk with no safety net now, in other words. All right, let's bring in Deborah Furr. She is founder and managing partner of ETF GI, which is a London-based research and consultancy provider. We also want to welcome Rachel Evans, who heads up Bloomberg News' ETF coverage. So, Debbie, Eric gave us his read on flows. You are based in London, so you can offer us a global perspective. Does this apparent rebound into international have legs, or is the U.S. market still the main attraction here?
I think for a lot of people, emerging markets is interesting as well as international. So we're seeing a lot of investors putting money into China A shares because we are probably going to see that being one of the best performing markets at the end of 2019. Mm-hmm. We're also seeing investors buy Saudi Arabia because it's moved into the emerging market index. Kuwait has moved into frontier. So often those changes cause people to look at these markets because if you don't buy any, you're underweight. And I think an interesting thing, if you look at the end of October data, we're at 401 billion of net new assets going into ETFs. Last year at this time, we were just 379. So I think this year is going to be a record in terms of flows. And right now, we're tipping at 6 trillion of assets, which is pretty exciting. So we're at records in terms of assets globally, US, Canada, Japan, and many of the markets individually.
All right, so new records all around. Rachel, over the past month, we've seen money flow into Europe specifically, and this is despite a range of concerns, whether it's a German recession possibility, the ECB running out of tools, or just Brexit uncertainty. What's going on?
Yeah, I mean, at first glance, it seems a little bit counterintuitive, but we have been seeing those flows. Looking at European ETFs as a category last month, we saw the first inflow since April and the biggest inflow since January of 2018. A lot of that money seems to be going into Eurozone ETFs. The EZU fund that was run by BlackRock and its hedged equivalent took in more than 500 million last month. So a lot of that is kind of going into those. And I think it's really kind of people looking at the situation in Europe and thinking, you know what, Christine Lagarde, maybe she's able to kind of like get some of that fiscal stimulus that the region really needs out. And maybe Brexit, perhaps now that we have the kind of makings of a deal over there, perhaps that's not going to be quite so bad. So people are starting to dip a toe back into Europe. It's not wholesale, everybody piling in, but we're seeing a few initial signs of interest there.
So Rachel just went over the U.S. investors' mindset. You're in Europe. That's where you're based. What's it like on the ground? Are people buying into their own market there? And also, has that new rule, MiFID, which is supposed to help passive and ETFs, has it kicked in yet? Seems like it might not have. What's your take?
Yeah, so I think, I live in London, so I think there's still a lot of uncertainty as to what Brexit means and what's going to happen and when do we get there, right? And some people don't want it at all.
Yeah, we could spend all day on this one, yeah.
Yes, exactly. So I'll kind of leave that aside. So I think MiFID II has been interesting. So historically, ETF trades didn't have to be reported. MiFID II required trades to be reported. We thought the trades would be on exchange. What we've seen is most of the trades are being done through RFQ platforms, right? Which means off exchange. So we've seen more trades being reported, but not on exchange. So 2/3 of the trades are done off exchange. And it also means that if you're an advisor, you no longer, if you're independent, can be paid to sell products. So that's been a big change in terms of advisors embracing ETFs, which means retail is embracing ETFs. So the use of ETFs is definitely growing, and investors in Europe are using European domiciled products and less of the US products because of FATCA and because US ETFs are not compliant with a lot of the regulations in Europe.
Okay, so still some growing pains there and adjustment pains. Rachel, your team published a story over the weekend about the pitfalls of zero-cost investing. Sure, it's great news for investors, at least on the face of it, but there is a dark side to all this cost-cutting, isn't there?
Yeah, so this was a great story by Claire Ballantyne that kind of sort of dug into some of the potential risks of zero. It sounds really, really good, like if you're paying nothing for your products, but there are some potential sort of side effects that you should be aware of. Number one, people don't do this for free necessarily. So there's a risk that potentially this is either kind of like a way to get people into a fund complex and then potentially be able to upsell more expensive products. There's also potential for issuers to want to do more what we call securities lending, where you lend out what's in the fund in return for a fee. Now that's capped from a regulatory perspective in the US, but there is the potential for you to take more profit from that rather than giving that back to investors. And there's something that I think is a little bit more kind of harder to measure. It's kind of potential corner cutting. Just in terms of who you hire to create an index, who you hire as a custodian, whether you have a full legal team kind of overseeing all your prospectuses, that kind of thing. It's harder to kind of measure, but there's a potential risk of people kind of trimming back a little bit much. And maybe if we do see kind of a lawsuit or some kind of problem for the fund in the future, that could come back to bite people.
Yeah, it could come back to haunt you, and that's always the problem here. Debbie, what do you think?
Well, I do think the rules in Europe are different than the US, and it is important to remember there are strong legal guidelines on ETFs because they're 40 Act funds or UCITS. But in Europe, you have to give back any of the securities lending revenue after covering the costs of the program, whereas Rachel points out in the US, the manager can keep that money.
Sure.
So I do think there's never a free lunch. Someone's making money somewhere. Either they want to use it as a reason to come and get your account open or something else, right? So
there's always a cost to it no matter what. Debbie Furr of ETF GI, thank you so much for visiting us from London. And Bloomberg's Rachel Evans, great conversation. We covered a lot of ground there. Now coming up, Nate Geraci, president of the ETF Store, talks about how active investors seek to stay relevant in an increasingly index-dominated world. And one ETF trend that caught our attention this week involves gold. Bullion ETF holdings jumped by the most since 2016 in the third quarter. That's according to the World Gold Council. This demand for gold has helped push prices up about 16% this year. A reminder, by the way, that you can find all the charts we feature on the Bloomberg at GTV Go. This is ETF IQ. I'm Scarlet. This is ETF IQ. Let's take you through the ETF life cycle, which has three main stages, and it all begins with the filing. The SEC will review a pair of Syntax funds, the Syntax Stratified Mid-Cap and Small-Cap ETFs. They join the large-cap version, which launched in January. All the funds use a proprietary stratified weighting methodology. Step 2 is the launch. Two Direction funds listing this week, the Direction Daily S&P 500 High Beta Bull and Bear 3x shares ETFs. Tickers HIBL and HIBS will be trading vehicles that provide triple daily exposure to companies that are most sensitive to market moves. And for some, the final stage is liquidation. Deutsche X-Trackers is shutting down 5 funds, a currency-hedged South Korean equities multi-factor EM equities, multi-factor small caps, and 2 currency-hedged fixed income funds. All the products had minimal assets. Time now to get passive aggressive, where we track the tensions between active and passive investing. Now, active investors seeking to stay relevant in an increasingly index-dominated world need to forge their own path. What are their most effective selling points? Let's ask Nate Geraci. He's president of the ETF Store, the first investment advisor to offer only ETFs. And Eric calls you one of the top 10 ETF nerds out there. You're in good company because he's one of them as well. Some active shops, Nate, are choosing to compete against the rise of passive by offering direct indexing. Eaton Vance, for instance, owns Parametric. Explain exactly what direct indexing is and why it's appealing for the active side.
Yeah, so I think most people are familiar with index-based mutual funds or ETFs, where you have all of the securities in a particular index. You own those in a single bundled product, typically at a very low cost. And all of the back end is handled for you. The trading, rebalancing, any corporate actions, very simple. Every investor is going to have the same experience. What direct indexing does is it removes that fund wrapper. Instead of owning the securities in a single bundled product, you own the securities direct. And what's happening is barriers have come down that have previously made direct indexing less feasible. So we've seen all of the major brokerages now go to commission-free trading, which has reduced a major cost of direct indexing. And there's a report that Schwab may offer fractional shares. I think most of the major brokerages are expected to follow in offering fractional shares. So that's brought down that hurdle. I think what's happening is asset management has become so commoditized that I think a lot of advisors are looking for a way to potentially add value.
Right.
And so they're looking at direct indexing as a potential solution.
So as an advisor, then, would you use direct indexing?
So I have several concerns around direct indexing. First and foremost is if you're taking an index, and what direct indexing does is it allows you to start with let's say the S&P 500, and let's say you have ESG views, or you have you don't want to own gun stocks. You can start tinkering with the index and removing those holdings. Well, in my mind, the more you start tinkering with the index, and the more you customize that index, the more that's active management.
Yeah.
And you're going to start running into tracking error.
Yeah.
And I think that's a concern for investors.
Absolutely. And even you mentioned ESG, which is a good example because a lot of clients are requesting ESG specifications, but how many really request for direct indexing specifically? Because the tracking error starts to become a big issue, right? They can't keep pace with the S&P 500. I just think of SUSA, the iShares Select Social Index Fund, which has underperformed by about 35 percentage points since inception. Like, how many people can really handle that day in and day out?
Well, and I think that's what it gets back to is investor behavior. What can an investor stomach? And I'm not here to argue the merits of active versus passive management, but the fact is when an investor starts deviating from an index benchmark, they may not be able to stick with that over the long term. And I think that's a real concern. Another benefit that's often touted with direct indexing is the ability for tax alpha. So you can directly tax loss harvest individual securities. Well, I think the data out there right now is inconclusive. And as you start drilling down, at some point you're going to run out of stocks that you can harvest for a loss. And the other part that plays into that is the more you tax loss harvest, the more you're going to start deviating from that benchmark index, which gets back to the investor behavior side of the equation.
All right, so there's always a cost here, and of course people have to be mindful of all of that. Another way that Active is looking to target advisors is with non-transparent active ETFs, the Presidian wrapper essentially. These are set to launch next year. What are your thoughts on those products?
I am still skeptical on the long-term prospects of non-transparent ETFs. The reason why is if you look over the past 10 years, we've been moving towards transparency. And right now, there are active, transparent ETFs that exist on the market. There are shops that are doing this pretty well. ARK Invest and Davis come to mind. I think as an investor, if you can have a transparent active wrapper or a non-transparent, which would you prefer?
All things being equal.
All things being equal. And if you look at, just as at a high level, the move has been away from active management as a whole anyway. So I just wonder how much traction these will be able to get. Now, if we have a mass conversion where if you're a traditional active fund shop and you can take your mutual fund, convert it into a non-transparent wrapper, if they're willing to do that, certainly these could initially have assets. But I am skeptical in the longer term prospects.
Nate, one area that seems to have worked for old school active is converting their secret sauce, their magical ingredients, into an index through smart beta. This is seen as kind of a savior. Does this work, and do you use any?
Good question. So we do use some smart beta. The way we view this is as the automation of active management. So this is active management, but you're removing the human bias and emotion inherent in active management. I think the key here is, I'm going to go back to what we talked about with direct indexing. It's investor behavior. Does the investor understand the type of experience they're going to get? in that smart beta product, and are they willing to stomach that over the longer term? I think as long as that smart beta ETF solves a particular client problem in a portfolio, there's absolutely value to them. Whether you want to look at low vol or value or dividend, there is value there. But again, the client has to understand what the rationale is for that product and be willing to stick with it.
Right, understand their tolerance for pain and risk.
Absolutely.
Nate Geraci of the ETF Store, thank you so much for joining us. Now, coming up, we set sail for one ETF that is preparing for big industry changes to come in 2020. This is ETF IQ. I'm Scarlet Fu. This is ETF IQ. For every ETF that offers exposure to a factor or a strategy, look for similar funds to crop up. We've all heard the disclaimer that past performance is no guarantee of future results, except that there are funds trying to bet on exactly that outcome. Corey Hoffstein is CIO of Newfound Research, which just launched a new momentum-based fund. Before we talk to him, though, Eric Balchunas is going to give us the drill down into that fund, known by its ticker, ROMO.
Thank you, Scarlet. Yeah, ticker's a little tough to get over because I'm a Philadelphia Eagles fan, but that's my problem. It really stands for robust momentum, and that's what it is. A quantitative strategy here, very new, right? Just came out this week, actually. Fee is 87 basis points. And what you're getting here is it's going to go between treasuries and international and U.S. stock ETFs. It's an ETF of ETFs based on momentum and trend following signals. So let's look at what it holds. I mean, this is a very basic, easy to understand portfolio. It just holds these 4 ETFs in those weightings. But this is going to change, and it could change fast. It's a weekly rebalancing. That's rare. Normally ETFs are quarterly, maybe monthly. This one's weekly. And now let's look at the back test, which again, you got to look back test or back test, but it's all I got because it's new. And we look at it over the past several years. It's beating the growth, the S&P target growth. And there's the S&P 500, and there's ag. So it's going to be in between probably a stock and a bond performance. So, Scarlett, that's what this ETF does, and I think the performance will really be the way it gets investors.
All right, still with us is Corey Hoffstein of Newfound Research. And Corey, I want to get your thoughts on momentum overall, because Bloomberg intelligence data show that almost $1.6 billion was withdrawn from momentum-focused ETFs in the month of October. That is the most for any month on record. Now, the poster child for this shift is MTUM. Are we at a turning point where betting on previous winners is no longer appealing to investors?
Well, I think it's somewhat of a differentiated strategy for what most investors are used to. They're used to this idea of very Warren Buffett, pick a company, understand the quality, do that bottom-up analysis. The idea of picking a stock just because it's performed well is almost the antithesis of intelligent investing. And yet, the empirical evidence really shows that it does work. But it is a strategy you need to stick with. And it's one of those that I think if people are trying to time momentum, it's not going to work out very well for them.
And let's just separate, on Twitter, this gets confusing, trend following and momentum. Momentum is just sort of following what does well. What's the difference between trend following and that?
I think this is especially confusing because trend following and momentum are often measured the exact same way. What the real difference is, though, is momentum is trying to find outperformance opportunities by comparing the performance of 2 assets or 2 stocks, A versus B. Trend following is really more of a risk management tool, simply trying to say, is the return positive? Yes, we think then we should invest. Or is it negative, in which case we might want to divest away from that security.
Okay, so it's a matter of comparing or looking at something on its own merits. You're at Newfound, which is an ETF strategist. So obviously you use ETFs. How does your use of ETFs inform your process of designing an ETF?
Yeah, so we very much have been on the forefront of using ETFs. We've been an ETF strategist for 11 years. We use ETFs really as an efficient vehicle for implementing trades. And so for us in thinking about coming to market, partnering, bringing an ETF to market, we looked at all the same things we tend to look at. Is this something that can be priced efficiently? Is this something that's going to trade and have enough liquidity? And all that was really important in informing who we partnered with to try to bring this strategy to market.
This is your first ETF that's yours, but you actually participated in the launch of NTSX, that Wisdom Tree 9060 fund. You were part of a group of people on Twitter who got Jeremy Schwartz's attention to launch it. It's a 9060. Make the case for this one. It's done well, but it's only got $37 million. Is it because it invests in 2 asset classes and advisors don't like when you become too much of the advisor?
Yeah, it's a brave new world when ETFs are launching because of Twitter conversations, but that's where we're at today. You know, I think this is a really interesting product, and perhaps it's almost crippled by both its simplicity and its complexity. It's a 90-60 levered strategy. It's a 60-40 taken up 1.5 times. Very simple to understand, but leverage can scare people. But I do think this is a prudent use of leverage, where we're introducing a diversifying asset class. You get the benefits of stocks and bonds in one package, but really towards that equity-like risk characteristic.
But at the same time, as Eric puts it, it doesn't really leave a lot of room for advisors to add value, and that's what they need to do.
Well, I think this can be considered a capital-efficient trade. What I mean by that is an advisor can put a little bit of money in this, get both stock and bond exposure, get $1.50 of exposure for every dollar they put in, and actually increase and open up room in their portfolio for alternatives that they might not have had room for before.
Okay, or they could put money in Romo as well.
Absolutely.
There you go. Corey Hofstein of Newfound Research, thank you so much for joining us today. Now, we like to say that the ETF industry has something for everyone. The global shipping industry needs to adapt to new maritime rules, and that means investors must chart a course through that storm as well. Check out this week's There's an ETF for That. The Invesco Shipping ETF takes investors out to sea. Trading with the ticker SEA, the fund tracks high dividend payers in the global shipping industry. Investors can use C to position themselves before IMO 2020. The new international marine regulations that start in January and limit the sulfur content in fuel. Ships are expected to install scrubbers or use low-sulfur ship fuels ahead of the rule implementation, with additional compliance costs to top $60 billion over the next 3 years. According to Bloomberg NEF, the scrubber order book stands at more than 3,700, with around 3,000 expected to be installed across the fleet by the end of this year. As for the fund, C contains 25 names, including Maersk, Mitsui O.S.K., Nippon Yusen, Euronav, and Scorpio Tankers, all flying flags from around the world. C has some $50 million in assets, an expense ratio of 66 basis points, and weights its holdings by market cap. Since launching in 2010, C has struggled, losing money versus the more than 200% return in the S&P 500, but it's been able to sail faster over the past year. C gets a green light in the Bloomberg Intelligence traffic light system. Now, the maritime rule is obviously something that investors need to watch out for, but I could see this being a proxy for people's concerns about global shipping and global trade, which is under the microscope these days. Yeah, no, this is one of those ETFs concentrate. I think it has a lot of Denmark in it, and it can actually just pop. And if it does, people will buy it. What's interesting about this one is it shows that this thing's been around. It actually got resurrected, but largely it's been around for over 10 years. And it's carved out a nice little living for itself. It'll never be VOO, but it shows that you can get a theme ETF and find a little bit of an audience. But it's amazing the shelf life this thing has had over the years. Very few funds eventually make it to VOO status. Yeah, very few. All right, that does it for Bloomberg ETF IQ. Be sure to catch us each Wednesday at 1 p.m. New York time, 6 p.m. in London. This is Bloomberg.